Target's on the tape. They're saying the expected 25% increase in tariffs is baked into guidance. So how many companies do you expect to cut numbers? And then what are their options in terms of sourcing?
Look, first of all, the people that have been winning all along. Discounters, internet companies, value players like TJ Maxx. We're seeing what's expected. Department stores are losing. That's nothing new. When you take a look at the impact of tariffs, certainly there are areas that are particular hardships, like private label apparel. Toys is one that's very heavily concentrated in China. Bicycles that are difficult to move. And it sounds like the administration is trying to find those real pain points because maybe they might be excluded or somehow treated specially. Beyond that, I think we all need to pause a second. There's not going to be a 25% increase in the cost of all these items. And the reason is because there are alternative sources and companies have been working on this for a long time. It really should be just a single digit, increase, low single digits over time, because obviously they're in China because it's the best place to be there. But you have the rest of Southeast Asia, Vietnam, Indonesia, Bangladesh. You have India, you have North Africa, you have Eastern Europe. You have plenty of places to go as alternative sources of supply for most of these products. And that's what the big and smart retailers have been working on and will work on a lot more. Again, it's not what people want because they're in China for a reason.
When you say they've been working on it for a long time, this alternative sourcing method, why did they start moving? Was it because business in China just got too difficult?
Well, the first thing is people have been moving for a long time. China is not the low-cost manufacturing solution for many products anymore. And manufacturing tends to migrate to the lowest cost source of production. So many industries have already been migrating. Apparel is one that's been diversified globally for quite some time and continues to do so. But China is just so darn big that it's going to take quite a while to place all those products. So they've been moving before any of this came about. And then once people heard about tariffs, certainly that's accelerated efforts to look elsewhere for supply. So there can be other sources of manufacturing over time. It doesn't mean there won't be short-term dislocations in many categories, because of course they will, because it's not just manufacturing costs, it's know-how, it's machinery, it's other things that take a little while. But whether it has an effect on the fall of this year is one thing. Whether that effect is very large, as you look out next year or the year after that, that's a different story altogether. And meanwhile, of course, it may be solved before any of that comes into play. Go ahead.
Yeah, I mean, Jerry, I hear you, but we've also been listening to some of these conference calls, and a lot of these companies still have, say, 20% of their production coming from China. That's not an insignificant number. That was a number I heard from Urban Outfitters last night. They've taken it from 30% to 20%. I think Adidas does about 20% of its total volume still in China. Under Armour, kind of a similar number. I mean, that's significant. We're going to feel that, aren't we?
And in the short term, we certainly might. But capitalism is infinitely flexible, and it will change. And one of the things I might comment on, you may notice that the concerns are loudest from those who have the weakest numbers. And I don't mean to, to make a joke out of that, but that really is true. And so you hear from people who are doing well, we're going to be able to handle this. We're on top of it. We know how to do it. It's already in our guidance, that kind of thing. And there are people who are struggling in other ways that are saying, well, it's the weather, it's this, or it's that. That's very typical.
All right, but Jerry, we can go back. I know it's a long way when you were running Toys R Us, which obviously I would think sourced an awful lot of its goods from China. So if you're a CEO of one of these companies where you still see a lot of your stuff coming from there, what are you doing right now in terms of trying to make sure you're not passing that cost on along or much of it along to the consumer so you can stay competitive?
Right, and you do pick a category in toys that is heavily concentrated in China. I would say as much as 75% of toys do come from China. Toys, bicycles, there's certain categories that are very intensive there. It will be impossible to shift all that production elsewhere. And so there will be price increases. So what you're taking a look at is where you can take those price increases and pass them along. And it's not great, but it's not all bad news for retailers. Many have seen no inflation for a long time. We've talked about that, in the economy as a whole. That isn't good for retail when there's no inflation, because you have fixed costs that do continue to rise. Costs for rent, wage rates are under incredible pressure, keep rising. So a little bit of inflation may actually improve the bottom line, ironically enough, for some of these retailers. So you're going to look at where you can pass it along. And, of course, you're going to move rapidly to see where you can procure goods that aren't subject to these tariffs. And, it won't be possible in every area. And I think that's why you hear the administration making these calls and trying to understand, okay, which areas are just impossible to find elsewhere. And toys is one of them that is very concentrated in China.
Right. In terms of other pressure pain points, Jerry, furniture you mentioned, we talked about toys. Where else does it extend? Would you be looking at luxury, especially if there's some sort of nationalistic movement to exclude American brands?
Well, luxury is an interesting question. So luxury is heavily sourced from Europe. So in terms of the cost pressure, the tariffs largely don't apply. But if you're selling in Europe, China has been a big growth market for a lot of these players for a very long time. And so you have to question whether that may not slow down. It has slowed down a little already, again, I might point out, because of the overall slowdown in the Chinese economy. So that certainly is a potential pressure point as you look down the line. I'd also highlight private label apparel. And I think you mentioned, Kohl's. Companies that have high private label apparel are getting a lot of it from China because that's where the supply chain has been. The costs are pretty good. It is not the lowest in the world anymore, though, in China for private label apparel. So, and that's something that can be put up and run very rapidly elsewhere. And so you will see that production shift. Turkey, North Africa, again, Eastern Europe, Bangladesh, Vietnam, India. There are going to be other places that will grow to make up for that over time. But in the short term, that's going to hurt a lot.